Hi, friends. Sorry I haven't posted in a while. I've been very busy adjusting to Nomad life, but I am really back now. I hope you're having a great day. I am in amazing Boracay in the Philippines, and it is raining. But even a rainy day in Boracay is still a great day. I thought I would share a simple option selling strategy that you can use in your own trading. It is very hands off and beginner friendly, but it is also a strategy I still trade now from time to time. But before I begin, as always, I am not a financial advisor. I am sharing my journey and what has worked for me. I do not know your life situation or risk tolerance. I hope you find my content educational, but seek out other traders and resources, as well as a financial advisor who understands options. In the meantime, you can start paper trading this strategy right away, and I do recommend that. Paper trading is extremely useful when adding a new strategy you're unfamiliar with. With that said, let's get into the trade. So today in part one, I'm going to give you a very brief overview of option selling. Then I'm going to talk about the put credit spread, which is the core concept of this strategy. Next time in part two, I will give the specific trade. So what to trade, when to trade, and when to exit using the put credit spread approach. And then in part three, I will wrap it up by touching on being creative as a trader and an example of how you might customize a strategy like this one. Okay, let's begin. Option selling overview. A proper introduction to option selling would take an entire book or more. I'll suggest some of those in a link below. This overview will also be slightly simplified. At its core, option selling is just like being an insurance company. Only instead of insuring a house or a car, you are insuring the stock market or some other market. Just as an insurance company is paid to take on the risk of losing your home, an option seller is taking on the risk of a market downturn. And also, like an insurance company, you will normally leave some amount of padding between where the market is and where you start being responsible for those losses. In insurance terms, a deductible. Let's look at an example selling insurance on Uber. There's a lot on here, but just focus on the highlighted row. Just focus on the list on the right side. These are called put options and act like downside insurance, as I've just mentioned. Each row on the right is one of these insurance policies that you could sell. So I've selected one that expires on September 15th. Today is June 28th. The option on this row has a strike price of 40. Selling this put option makes me responsible for losses below $40. Uber is currently at $43.83, so that makes me safe from the first $383 of losses. Note, stock options work in 100 share increments per one option. Right? So below 40, I am responsible for the losses, and if Uber went to zero, I would lose the entire amount of $4,000, $40 times 100 shares that I'm protecting with the insurance. By selling this policy, I collect around $152, which I would keep. So actual max loss is $4,000 minus the $152 I was paid for taking the risk on. So that's $3,848. So my maximum return is $152 that I had collected if Uber remains above 40 by September 15th. This is a return on the $3,848 maximum loss of 4% in 79 days. Not exciting, but not bad. And to be clear, that is the maximum return. Some trades will make less or lose money. So, put credit spreads. Okay, so that was a nice start, but now let's discuss put credit spreads. $4,000 is a lot of money. What if you don't want to risk that much? Well, just as smaller insurance companies often buy catastrophic insurance from large ones like Lloyd's of London, you can also buy catastrophic insurance further down the chain. Let's use the $37.50 strike from that example before, right? So we're going to sell the $40 put option and at the same time buy a $37.50 strike put option below it. This is sent as a single order. Since the $40 option is closer, it is higher risk and you are paid more for it than what you have to pay out for the $37.50 option that you're buying. So you still get paid a credit, in this case $60. If Uber stays above 40 by September 15th, you keep the full $60 as profit. The most you can lose is the difference between the strikes, so $2.50, which is $250 since again, options are based on 100 shares. But you keep the $60 no matter what. So really your max loss is $190. This makes your return, in the best case scenario, 31% in 79 days. That is phenomenal. Of course, it doesn't happen every time, and sometimes you will lose the maximum. That is why you should never put all of your money into any single one of these trades. Okay, that's a very quick and dirty introduction to a very popular option selling technique. In the next video, I will use this structure with some specific rules covering what to trade, when to trade it, and how to manage the trade once you're in it. Please consider subscribing, and I will see you there.